Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of understanding and managing default risk in investing. Understanding default risk is crucial for anyone investing or planning to invest. It's the possibility that a borrower won't be able to pay back their loan. If you're an investor, knowing about default risk helps you make smarter decisions and protect your money. In this video, we'll break down what default risk is, why it matters, and how it can impact your investments. By the end, you'll have a clearer idea of how to assess this risk and make more informed choices. So, let's get started and demystify the concept of default risk in investing. Understanding default risk. Default risk is a critical concept for anyone investing in financial assets. Knowing how to identify and manage default risk can save you from significant financial losses and help you make more informed investment decisions. Let's break down what default risk is and the different types you might encounter. What is default risk? Default risk is the chance that a borrower won't be able to pay back their loans. When a company or individual takes on a loan, they promise to pay it back with interest. However, there's always a risk that something will go wrong. They might run out of money, their business could fail, or they might prioritize other expenses over paying back the loan. When this happens, they default on their loan. For example, if you buy a bond from a company, you're essentially lending them money. If the company can't keep up with its payments or goes bankrupt, they default on the bond, leaving you with unpaid interests and possibly even losing your initial investment. Types of default risk. Default risk doesn't come in just one flavor. There are different types that investors should be aware of. Credit risk. This is the most common form of default risk. It refers to the risk that a borrower won't be able to meet their financial obligations. For instance, if you loan money to a friend and they can't pay you back, that's credit risk. In the world of investments, bonds and loans are subject to credit risk. Counterparty risk. This type impacts financial transactions. It happens when the other party in an agreement, like a trade or a contract, fails to fulfill their part. Imagine you buy a stock and the broker doesn't deliver it. That's counterparty risk. This type is common in derivative contracts and trading activities. By understanding these types, you can better assess the risks associated with different investments. It's like knowing the difference between small and big waves before hitting the beach. You're better prepared. In financial terms, this means being able to pick safer investments or demanding higher returns for taking on more risk. Investing always involves risks, but knowing about default risk can help you make better choices. Stay informed and always do your homework before putting your money into any asset. Factors influencing default risk. Default risk is a critical factor to consider when investing. It represents the likelihood that a borrower will not be able to make the required payments on their debt. Understanding the factors that influence this risk can help you make better investment decisions. Economic conditions. Economic downturns can significantly increase default risk. When the economy struggles, companies and individuals may find it harder to generate income and maintain cash flow. This can lead to a higher chance of missing payments on loans or bonds. During a recession, various industries might experience reduced demand, leading to lower revenues. For instance, retail businesses may see fewer sales. Manufacturing companies might cut back on production. Service-based industries could face a drop in clients. As these challenges accumulate, even well-managed companies can face financial strain, increasing their risk of default. Company financial health. A company's financial health is another crucial factor in assessing default risk. Key financial metrics can offer clues about a company's stability and ability to meet its obligations. Some of the most important metrics include debt-to-equity ratio. This measures how much debt a company is using to finance its operations compared to its equity. A higher ratio means more debt, which can be risky. Current ratio. This ratio compares a company's current assets to its current liabilities. A ratio below 1 can indicate liquidity issues. Interest coverage ratio. This shows how easily a company can pay interest expenses on outstanding debt. Lower ratios suggest higher risk. Profit margins. Companies with shrinking profit margins might struggle to cover their costs, including debt payments. Monitoring these metrics regularly can help investors spot potential problems early. Market sentiment. Investor sentiment can also affect perceptions of default risk. When investors are confident, they might overlook some risks. Conversely, if sentiment turns negative, even small concerns can be blown out of proportion. Consider the ways market sentiment can shift. News reports. Negative news about a company or the economy can spook investors. Stock performance. A falling stock price can create a sense of doom, leading to panic selling. Analyst ratings. Downgrades from financial analysts can trigger a loss of confidence. Understanding how sentiment influences market behavior can help investors navigate periods of uncertainty more wisely. Assessing default risk. When thinking about lending money or investing in bonds, understanding the risk of default is crucial. Default risk is the chance that a borrower won't be able to make the required payments on their debt. This section will help you understand how to assess that risk by looking at two key areas: credit ratings and financial analysis techniques. Credit ratings. Credit rating agencies play a big role in helping investors assess default risk. These agencies, like Moody's, Standard & Poor's, S&P, and Fitch, rate the creditworthiness of borrowers. Their ratings range from high, indicating low default risk, to low, indicating high default risk. Here's how credit rating agencies work. Data collection. Agencies gather financial data about borrowers, such as their balance sheets, income statements, and cash flow statements. Analysis. They analyze this data to understand the borrower's financial health. Rating assignment. Based on their analysis, they assign a rating. For example, a high rating like AAA means the borrower is very likely to repay their debt, while a low rating like D means they are at high risk of default. Credit ratings are useful because they give a quick snapshot of a borrower's creditworthiness. However, they aren't perfect and can change over time. It's wise to keep an eye on ratings but also consider other factors. Financial analysis techniques. Besides credit ratings, investors use various financial analysis techniques to evaluate default risk. These techniques often involve looking at financial ratios that offer insight into a company's ability to repay its debt. Key financial ratios include debt-to-equity ratio. This ratio compares a company's total debt to its shareholder equity. A high ratio indicates the company is heavily financed by debt, which could be risky. Interest coverage ratio. This measures how easily a company can pay interest on its outstanding debt. A higher ratio means the company can comfortably meet its interest payments. Current ratio. This focuses on a company's ability to pay its short-term obligations with its short-term assets. A higher ratio suggests better liquidity and lower default risk. Example analysis techniques. Trend analysis. Look at how these ratios change over time. Improving ratios can indicate a company is becoming less risky, while worsening ratios may signal trouble. Industry comparison. Compare the company's ratios to industry averages. This helps to see if the company is performing better or worse than its peers. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.